What is up, guys? I'm back yet again with another one. Today, I'll be talking about making sniper entries using strike levels. All right. So strike levels are nothing universal. It is basically just my concept that I use as per my trading. So you can't expect to find this information anywhere else, to be honest, because this is how I choose to view the markets. And I chose to share this information with you right now. All right, so let's get straight into it. All right. So with this strategy, you always want to look at the market structure, of which, if you have been following me, you realize that we pick up the market structure on the H4 and above so that we can find our key points of interest where we want to take trades. So the current market structure on the chart that we're looking at right now is that of an uptrend. Why is this an uptrend? Clear basics. We have higher highs and we have higher lows. So we want to be looking for buys in this market. So let's just take a quick example of this order block right here. This would be a buying key point of interest. Why is it a key point of interest? First of all, it's a buying order block in a buying market. Second of all, it's an element of market structure whereby we have found this order block on the H4 and above. So it's a key point of interest where we're saying when price comes back in here, we want to look for buy entries. But because you're trading with me, we want to look for good entries, sniper entries. We want to minimize risk and lessen drawdown. All right. So this is where my concept of strike levels comes in. Okay. So what are strike levels? When you have found your key point of interest, all right, you then add strike levels to your key point of interest. Strike levels are whole numbers. So you decorate your key point of interest. For this example, the key point of interest is an order block. So you decorate it by adding whole numbers that are associated to the level that you have found. So let's do this real quick. I would say this is level 13,600. You just decorate the whole key point of interest, right? Let's move up with the price, level 13,700. We're just looking for whole numbers. Remember, these numbers are different for each instrument. So you want to basically make sense of whatever instrument you're trading, and you find a proper spatial difference, an equal spatial difference, and you place these key strike levels, okay? Then 13,800, let's move in. Let's try to be a bit more quick, all right? 13,900, okay, all right. And lastly, I would put level 14,000. Okay. All right. Level 14,000. All right. Now that we have our strike levels and we have our key point of interest, our job is to always look for entries on the lower time frame, right? But what these strike levels help you is in making sniper trades. Because remember, with all the strategies you have been taught that once price comes into your key point of interest, you just place your buy entries here, and then your stop losses are all the way down here, which is ridiculous, right? Look at the risk to reward ratio. It's not that great. We want to actually study what happens when price comes into our key point of interest. And I know for a fact that price starts respecting our key strike levels, all right? And it gives us an idea of what's actually happening in the market. So for this example, price came in, it fell below level 14,000. It's okay. And then it fell below level 13,900 and it bottomed at level 13,800. At level 13,800, we can see that buyers started coming into the market and it broke 13.9 and it broke 14,000. Now we're gaining confidence that the buyers have decided to engage in the market, and now we can actually look for buy entries. So for this example, I would have actually bought the market when this candle closed firmly above 14,000. I would have placed my entries here. And where would I have put my stop loss? Below maybe level 13.8 or even level 13.9, because I'm guided and I'm guarded and I'm secured by the strike levels. All right. So a common misconception is that, oh, these things don't matter. Sir, you have to know these things. These things matter. Okay. These are not just random numbers. There's literally orders being pushed into the market at these key price levels that I have chosen to call strike levels that are in your key points of interest. Understand this and you will suffer less when it comes to crazy amounts of drawdown. All right, let's look for another example. We have the volatility 75 H4 time frame. Let's look at what's actually going on. I see a market structure of a consolidation in this region, right? This is a resistance and this is a support. Okay, so you know that our market structure, we always pick it up on the higher time frames, and in a consolidation in a range, the support becomes our key point of interest for buys, and our resistance becomes our key point of interest for sells. So for this example, let's actually decorate our support and add strike levels to it to see what would have happened. So let's use this point and this point. Why are we using that? Because we have one touch, we have two touch. That's enough for us to say this is the support level. And we wait for price to come back in here so that we can place buy entries. And also here, we could have placed buy entries, but let's decorate the strike zone. And we see how we would have entered. So let's look for whole numbers the whole way. Okay, I'm just going to start at level 610,000. 610,000, right? Cool. 614,000. Equal spatial difference, all right? 614,000, all right? 618,000, right? 18. I know it's a bit monotonous, but these things matter, like I keep reiterating. Master this and you know your entries could just be better. Trading is a game of entries. If you can enter the market properly, you know, you become better. You become a successful trader. The other stuff, oh, it's a long journey. I can tell you that if you don't understand how to enter the market, it just becomes a crazy time for you, right? So let's scale down to the lower time frames to see how we would have entered this market using the strike levels that we have seen, right? So just want to use this example right here. So we're going to go to the M15, all right? M15. Okay. So what has happened, guys? All right. So remember, this saves you from just entering blindly here. Price comes into our key point of interest. You can see that level 622,000 is actually holding. All right. So now this strategy also helps you to assess what we call liquidation in the market. Before a market moves up, they like to take stop losses. Okay. So you can see that here it failed to break level 622,000 and they bought the market. So someone who's not really experienced would have bought here. But I know for a fact that there's liquidity here, and that's exactly what they came to grab. They took out the stop losses of the people who bought here, and that was the first liquidity grab. And guess which level was respected? Level 618,000. They fake bought the market, and they liquidated the guys who got in here again. So they liquidated 622,000. They liquidated 618,000. Now, on the third move, that's when they decided to move the market up. They did not liquidate this. So what I would have done, as per this strategy, I want you to understand that if you see liquidation pressures in the market, I want you, if there's two liquidations, take the third entry. Okay, two is enough. They hardly liquidate for the third time. Okay, so if you've seen these guys have been liquidated, you enter the market, it's fine. But either way, even if you had entered here, you know you could put your stop loss around 614,000 or even around 610,000 because you're covered, you're guarded, you're secured by the strike levels. As you can see, price definitely respects these price levels, these whole numbers, these strike levels when it comes into your key point of interest. So master this, your stop loss placement is going to be lit. Also, you're going to be able to see liquidation pressures within the market. Okay. So here I would have entered the market somewhere here, placed my stops maybe at 614,000 to just make sure it's secure, and that will be that. Okay. So remember, this is still a support region, right? So even when price comes back, you can look for the same things. Look for the strike levels, decorate. I call it decoration, by the way, with my students. Decorate your key point of interest and you add strike levels to it, and you will thank me later. All right, let's just look for one more example. I don't want to take too much of your time. Let's see if we can find something. Okay, fine. So this is the volatility 50 daily chart. So that's enough for us to assess the market structure. I can see this order block right here, this daily order block. Okay, so we know that the market is meant to sell in here. But where is the question, sir? You know what I mean? We can't just enter when it just enters here and then we put our stop loss there. That's ridiculous. So what do? We decorate the key point of interest. All right. So for this one, I'm trying to see what numbers could I use really quick. What numbers could I use? All right. So I would say level 225. Yeah. Level 225. Okay, cool. Level 227.5. Let's see, 27.5. We're decorating the key point of interest and we're assessing the behavior of price action when it has reached our key point of interest while we're on the lower time frames. Okay, level 230. Then I'll end with level 232.5. All right, our job then is to go on the lower time frames and see what's up. Let's see what's going on. So now we pick this up on the daily, so we can scale down. We could even maybe place entries on the H1 or M30, just depending, right? So let's scale down. Let's see how price reacted. It will be respecting these strike levels, sir. Understand what I'm saying? So as I've been saying, we will not enter the market just because the price has gotten into a key point of interest, i.e. the gray zone, then we just press sell. That's retarded, right? So we want to see what's actually happening. Price enters our key point of interest. We don't do anything right? I mean, rushed, right? So we see it hits level 225,000, all right? It starts lingering between 225 and 227.5. Looks like it wants to break level 227.5 and it's failing to. And then guess what? The sellers engage in the market and they're now breaking the price levels going down, all right? So this for me, actually, when I see this candle here, I would have entered the market, okay? All right, because I know for a fact that price is failing to go up to the higher price levels and my stop loss would be guarded by level 230. If I'm a scaredy cat, then my stop loss is guarded by level 232.5. All right, so that's basically it, guys. Today, it was a quick one. I just want you to find your key point of interest on the H4 and above. In a consolidation, your key point of interest is a support or a resistance area, all right? In an uptrending market, maybe you're looking for buying order blocks. In a selling market structure that you've picked up on the H4 and above, maybe you're looking for selling order blocks, all right? Or structure highs and so forth. Find your key point of interest, decorate the key point of interest by adding whole numbers with equal spatial difference and assess behavior of price when it comes into your key point of interest so that you have good stop loss placement so that you can assess the liquidation that's happening. Okay, so I'll even give you an example here. When price got in here, you know, maybe some people who just see some selling candles, they start selling. And guess what? Level 2, the sellers here at level 227.5 were liquidated by this move. Your stop loss is hit again. All right. So this will save you because you actually have an understanding of what's happening. All right, guys. And then with regards to my mentorship, as usual, we're still going ahead. Many people signing up, and I suggest if you're struggling with trading, you should do that too, because my mentorship is not just about learning. It's also most importantly about unlearning the things that may be affecting your trading so that you're not profitable, right? So we get to diagnose your problem and we see what the problem is, and then we can see if we can fix the situation for you. That's why it's one-on-one. It's one-on-one so that we can fix the situation for you and we come up with a plan for you to become consistent in these markets. It's a possible thing. Consistency is a possible thing, right? Okay. And then with regards to my trading playbook, it's also available. And then I have my setup, my trading setup and analysis group that is going ahead. I really just wish to show you right now so that you see how that is. All right. So yesterday, I'm not going to scroll down into a lot of history, but yesterday alone, we took 2 trades and all of them were in crazy amounts of profits. As you can see, look at this. So I think the first one was a V75 trade that I called, and this is what happened. I called it and then straight into profits. The first take profit was smashed, as you can see over here. And the second take profit was also smashed, all right? And then I also called a V25 trade that went into crazy amounts of profit. Look at this. This is the H4 time frame. Look at this. These are all just profits, all right? So this is what we're doing on the trade and setup group. What I love about this is that I've kept the platform open, meaning that when I send a setup, you're free to ask questions, okay? It's not like a normal group. The alerts come to you as a personal text so we can actually interact, all right? So make sure you hit me up, contact me on WhatsApp, and let's take it from there. Happy trading, guys, and thank you. Ciao.